where behavioral finance, understanding of behavioral finance errors can help. So people dislike losses more than they enjoy gains, and um, this is enjoying gains, and hence people are willing to gamble more in domain of losses because um, I hate losses more than I uh, enjoy gains. That I've already talked about the joy associated with gain, with the happiness linked with the gain is less than uh, the discomfort that I have with the loss. And this is why panics are bigger motivators than greed, because greed will go up and there'll be a euphoria. Sugar will start going up and it'll keep going up slowly and it will be like a rocket. But when it is a panic, then it's faster, it's sharper. It's there are you will heard about Zechelasuta Shanghai making 10% in a day. You do not hear about 10% in a day rises, growths. So these are there are also 10 percent growth happen here also. There is Chinchpila Sutta growth here, but I'm saying generally in markets, double digit panics are more historically witnessed than double digit rises, So because panic is a bigger driver than greed, and this is why volatility rises much faster in case of a fear than volatility rising when people are greedy. Because when people are greedy, they can buy the next day, buy the next week. But when people are scared, they want to sell in the same day. So these are the observed facts which are very clear. And this is one of the reason people are gamble more in losses than they are gambling in gains. And they will hold on to stocks that have lost value. They will hold on. There are so many technology companies which investors might be still holding on, though they have lost value, they have lost junk. Some of them might even got dislisted, like delisted, but still we keep holding because we it's very tough for us to get out of it. Very tough to book a loss. Very tough exit. Exit is the bigger challenge than the entry. Entry is easy, exit is harder. So these are some of the behavioral errors that have been talked about. It's a big subject and it's being written actively. We are going to be teaching in Cluj the subject for 14 credits, 15 credits and classes, and we are also planning a complete course on this subject. It's a very very large uh, large idea, and I think it does make people understand that how to overcome biases, and which I think is very important. But it also can make you feel insecure that on one side that come on that are people really so insane, foolish, and one may, but again, I don't agree to that because I think that no, people are not that foolish as the subject claims it to be. There are people learn, people make a loss, they come back again, they train themselves, and that perseverance is something that behavioral finance does not talk about. People who got bust in a crisis come back in the next crisis, burn money again, and then they make money again. So the whole idea of perseverance, challenge, determination, and learnability is something behavioral finance does not speak about. And so the capital loss, extreme capital loss makes a sale 32% less likely. If you have a loss, you are less likely, 32% less likely than a gain to close it. There's a higher chance that you will not book a loss, and if you have a major loss, a 32% higher chance than the extreme gain, because if you have an extreme gain, you have a 32% probability, uh, lesser probability to book a gain than you if you have a loss. If you have a loss, there is more chance that you will not close it. Moderate capital loss, if you have a little loss, then of course 21% chance. And trading according to big behavioral finance theorists is hazardous to your health. I do not know of any other exciting vocation, any other exciting way to learn, any other exciting approach to life than understanding economics, understanding finance, understanding how 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 sentiment can be measured. But according to these two thinkers here, trading is hazardous to your health. So you really need to read the subject to um, to which I think is a very profound idea that that very few investors are uh, diversified enough. We have small portfolios. We need to broaden our portfolio, and most investors, majority of investors, have very small portfolios. And small portfolios bring larger risk. Larger portfolios reduce risk. So if I was having many assets, if I had bonds, if I had metals, if I had agro, if I had futures, if I had equity, if I had indices, index ETFs, I have still a broader portfolio. But if I'm only in stocks, or if I'm only in SIP 5 and SIP 2, then this is increasing my risk as an investor. And behavioral finance says that majority of the investors are trading few stocks. And this is also very clear that SIP 5 and SIP 2 are the most traded assets. People are more interested in trading one asset or two asset. Even in India, there are investors who are so focused on one nifty futures, one index future. They don't do anything else. Just there are now trading books written about it, which says how to make money on S&P futures. Now, S&P futures, now these are very poor risk management strategies, though they may look very exciting to a day trader, how to make a trading strategy with just S&P, just S&P, just S&P. But I agree that this is a high risk strategy and one needs to move into multiple assets, move into a larger portfolio and have a mix of assets, because even if you're trading futures, one can allocate to multiple assets. So now you have gold, now you have euro RON. One should try to move into to multiple assets, because at least the possibility of a loss reduces, because if you lose on one asset, your all portfolio comes down. But if you have three assets in the portfolio, six assets in the portfolio, your one asset loss will not create a big problem for you. So this observation is extremely important, and I agree that a broader portfolio is very important. And now what we are doing for what advice we give to our clients is about creating a portfolio where we have spot assets and we have futures, and we are moving telling them how to have metals or agro. There are so many instruments available today which can be used, and even on Cybex there are instruments that can reduce risk, and these are the things which should be tried. I don't think there should be any problem in doing you in feeling that okay, I understand SIP 5, I don't understand Euro ROM. This again is a kind of bias which again Herbert Simon clearly mentioned that irrespective of the content, the system are similar. So if you are using if you're trading SIP 5, you are anyway connected with Euroron. Why not also move into another asset class if you already can handle risk? So these are the some of the important ideas. Then of course, behavioral finance focuses a lot on saving, and they say that saving is extremely important. Now again, this is somewhere I disagree. Not that it is not good to save, but behavioral finance doesn't understand whether markets can be hyperinflationary, inflationary, deflationary. They do not make any claim to understand it. For me, from a cycle point of view, there is a time to be in cash. There is a time to be in hard assets. And there is always a cycle between hard assets and soft assets, or tangible and intangible assets. So if our view of inflationary environment is coming, then cash may lose value, because if inflationary situation, cash loses value every day, every month, every year. Your bread is going to become expensive. So what cash you have in hand is going to buy less bread. So this again is not an idea which is being uh, which is being talked about in terms of reducing the risk and creating more saving. But again, saving may be good for some point of time in an economic cycle, but saving may not be good all the time. Saving more tomorrow, they have educated group of people, and they have a program which is called Saving for Tomorrow, where they try to motivate people how to save more. And then again, of course, the subject really says that the idea of guru is flawed, because gurus cannot help, and and you cannot benefit from gurus. No, no, no. Again, somewhere behavioral finance uh, judges the experts too harsh, because ultimately accountability, if you are looking for 100% accountability, or and you don't draw a line that whether the guru was right 65% of the time, you are judging him too hard. So behavioral finance, what I have read, they take one single individual call of a person who made in some point of time and he was wrong, so they say, you see that the guru went wrong. But again, I think it's somewhere behavioral finance is also biased, and market gurus have brought so much knowledge to how to invest, and how to understand risk, and how to see patterns in market, uh, that falling in love with guru or is so is of course wrong, and one should not really think that he's going to be 100% accountable, or not put the guru on a pedestal. But of course, the role of experts is kind of underplayed by behavioral finance, and which I don't really agree totally, because I do not see an objective research explaining an accountability of big thinkers who have made. Because Eliot said in 1935 that a big bull market, a decade-long bull market, multi-decade bull market is coming. Now, who judges Eliot, who died in 1965 and said in 1935 a big bull decade market is coming? He said it at sub 100 prices on Dow Jones. Now, this is not what behavioral finance judges. Behavioral finance doesn't judge Elliott, of course, but and behavioral finance doesn't believe in patterns. So maybe the fractal theory was not, has not been really talked about in in the subject. So, and big high volume winners, again, this we already talked about, that high volume trades um, may not deliver performances, because high volume is like market interest. When market interest is already there, maybe it is already late, and that's where one should volume. That is why volume is considered as a secondary indicator and not a primary indicator, because the real gains are to be made when uh, the before the high volume, and that's what we also wrote about, that one should buy before the noise of the activity starts, because that is what is your real gain. Then what do stock splits really signal? Stock splits are really do not translate into to consistent performance on the stock, and there is a positive drift. And then they also talk about option traders and and various others. So it's basically a compilation of behavioral errors and research papers proving that error. And this is the Hirsch Scheffrin book, Beyond Greed and Fear, which is one of the ones I've illustrated here, the ideas from that book. There's another book by Schiller, who treats behavioral finance